Welcome to this stock analysis update for Natwest Group. Please remember I'm doing these videos for fun, so speak to a financial advisor. NatWest are the UK's fourth largest bank, so they have systemically important institution status. They're currently yielding about 4% dividends. Actually, they have a stated policy of returning 40% of profits back to shareholders. They have a reputation for political activism, including the debanking of Nigel Farage. And actually, historically, during the big bank bailout in 2009, Her Majesty's Treasury actually bought up to 84% of NatWest Group bailout package. And as displayed in their headquarters, they've been somewhat of a organ of the state for many years. However, this relationship with the state could be good for shareholders. Rachel Reeves is started going on a spending spree, and it seems like there will be lots of free government money going to fund all kinds of schemes. And because of its historic relationship with the government, NatWest could actually be doing a lot of the lending there, so could profit quite well from that. And actually, this bank's at a bit of a inflection point because it used to be most majority owned by the government. Well, only this year, the government finally sold the rest of its position in NatWest Group. It has a fascinating history going back to 1658. And if you look at the first video I did on them, which was December last year, I go into the history of the bank at great detail. So if you're interested in that, take a look at that video I did. Also, throughout this video, I'll be referencing all kinds of KPI I've been updating for this bank. For all this stuff, if there's anything you don't understand, you can go back to the video I did last year where I break down all these different concepts in a lot more detail. But like I say, please treat this more like an update video on the data. So starting with their operating profit by business segment, most of their operating profits are coming from the commercial sector. It's going to include a lot of the free taxpayer money that will be coming our way thanks to Rachel Reeves. 39% of the operating profits from retail banking, which trade under these well familiar brands, with 4% just private banking, which is managed through their Coutts subsidiary. They're the ones that debanked Nigel Farage. Looking at their net income history, a very strong trend here, 4 years in a row. In terms of their income and expenditure, I break down every line item in that video I did last year. But the important things are that the net interest income is continuing to increase as of the full year results of 2024. And the expenditure is actually going down. Actually, part of my investing in banks idea is that with AI and the future technologies, it should actually be cheaper to operate a bank. And we are seeing evidence of this here. So, of course, overall in 2024, we got a similar operating profit, but a definitely improved net income from 2023. And I've looked at the first quarter data for 2025, where we have an increased estimate for income and net interest income going up by 14%, with moderating even more expenditure and net income estimated to increase. So I have that on this graphic here, where it's kind of similar to last year, but the important main points here is when you compare the banks back before the credit crisis to where they are now, they're looking in much more stable and better shape, where they're making money off the bread and butter things. It all plays into my investment thesis. In terms of the split by business segment, retail and private banking are kind of in decline a bit, but a lot of money is being made from the commercial banking sector in our current interest rate and yield curve environment. In terms of the capital ratios, we're looking even more healthier in 2024 than we did in 2023. The actual official limits are way down here, and there's encouragement by the governments to the banks to relax things a bit, actually. So we should be seeing a reduction in these capital ratios, still well above the limit they're allowed, which should mean more money lending and more money making. in the next few years. So I covered in detail in that previous video about the income of banks. It's all about how big their loan book is, or how much money they're lending, times their net interest margin. And what we're looking for, according to my investment thesis, is a dropping of interest rates by the central bank, with yields actually rising on the longer end, particularly around the 10-year point. And this has been happening. We see here the yield curve, and the way it's moving is exactly in line with our thesis. And I've zoomed in a bit here where you can see it's definitely tilting in the right direction for NatWest shareholders. Bond yields are in this interesting kind of technical pattern here, and so we're going to have to keep an eye on this. I'm not sure if we're going to burst up, which could happen when you think of historical trends. Here I've got the data going way back for UK 10-year bonds. If you go back to the 90s, yields of way above 7% were kind of really normal back in those times. So we're unclear if that's going to happen. Or one theory that I'm starting to develop is that we may end up in a channel here where it stays around where it is. So these are all things to definitely keep an eye on. It depends how it all plays out. So higher yields could in some circumstances still be good if we end up with a normalized curve, but things don't totally break. And also they mean a breaking of the system, and that could be bad. I guess ultimately a recession would lead to, in some people's view, it crashing below, which obviously would be bad for banks. But what we're kind of hoping for is for the system not to break, the money printer to keep on running. And in that circumstance, we could actually see kind of higher rates, or rates where they are, with them dropping at the lower end. This is why it's important to keep track of this. Like I say, what's pivotal to banks making money is how much are they lending and what their net interest margin is. And a normal curve is good for the net interest margin. In terms for the lending multiple of that equation, well, the net interest margins and the loan book are still looking nice and high and stable. In terms of the sector overall, the actual sector graph was fairly useless actually around the time of last year, but since then, Access Bank, who aren't even British, I'm not sure why they're included, and also HSBC Holdings have got vastly reduced holdings in as a part of this the sector pie. So actually, it's starting to turn into a kind of useful sector graph in terms of the composition within it. We can see how back before the credit crisis days, when we used to have high 10-year bond yields, that was when these banking stocks were way higher than they are now. And then in the zero interest rate period, we can see how the banking stock suffers. So now that we're back up to high 10-year bond yields, that's why I'm theorizing that we should see a return to higher bank stock prices. And we're definitely in a nice channel still in terms of the overall sector graph. And when you zoom into just the NatWest graph, and we get the same pattern, by the way, if we look at Lloyd's or Barclays, we see there was this lovely technical pattern that we burst out of, and we're in this beautiful channel. And when you go back, you can see just how much highly valued these bank stocks were before the credit crisis and before the era of zero interest rates. So obviously, compelling case here for more upside, particularly as long as we stay in this channel. Now, one thing to be wary of is stock dilution. So back in the glory days, you'll see that the number of shares issued is much more now, 3 times more than it was back in the glory days. And so you've got to bear that in mind. That will mean that the potential upside isn't the raw number you see here. You've got to take account for the stock dilution. But like I've said before, kind of like a doubling from now wouldn't be at all outrageous to suggest, but just based on the technicals and taking into account a bit the stock dilution. So in terms of the assets and liabilities, Again, I went into every line item in loads of detail in that December video. The derivatives numbers here are big numbers, but they actually kind of balance each other out on the assets and liabilities. One important thing to note is the loans to customers did drop a bit as of the first quarter this year, but it's still kind of at a higher number than it was back in 2018, for example. And we see an interesting increase in bank deposits and customer deposits, which is attributed to the fact that now that there's higher interest rates, you've got more people just keeping their money in the bank for the higher interest. But in terms of the assets and liabilities, by the way, how banks do their balance sheet is completely different to how ordinary companies do. Also, actually, with the income and expenditure, banks are just like looking at a complete alien species when you compare with other normal companies. But from looking at the assets and the liabilities, we do get an inkling into how banks operate. So when we look at the assets tend to be money that they've lent to other people. Now, 99 billion is cash held at central banks, but other than that, really the majority of their assets are loans to customers. And we see a breakdown of that here, where we see that half of that is actually just to mortgages, with 70% institutional lending. The 23% is commercial other, or just the more kind of proper economy. It's interesting that credit cards are only a tiny fraction. They're like the red slice you see there, as is kind of retail loans and overdrafts, which is the green slice here. So here we see kind of how banks work, because even though this is all money that the banks lent, the bank actually just creates all this money out of thin air and then lends it out. That's the magic of having a banking license. It just allows you to print money out of thin air and lend it to people. And on this money that they've created out of thin air and lent to people, they get nice interest rates in this current high interest environment. So they're currently getting about 4.4% on some mortgages, for example, and the base rate at the central bank's 4.25%. And then when we look at the liabilities side, the bank's balance sheet, that's actually the liabilities are actually money that other people have deposited with the bank. And as we can see, the vast majority of that is customer deposits. A lot of that is personal deposits, but then obviously there's also corporate, and then 11% is financial institutions. So what's interesting is the majority, 70% of these balances are term deposits where they have to pay interest. And I've summarized the interest they're paying there. But the beauty is that only 70% of these only 70% of these people are getting are getting interest on what they've deposited with the bank. Obviously, in a modern economy, you can't really exist without having a bank account. So you've got kind of a captive audience, and the majority of individuals have got less than 500 quid or something in the bank, and people are just like juggling paying off bills and stuff. So they've not got enough to put it into a savings account. So the majority of the deposits here are captive audiences. And so of course that means you don't have to pay people any interest. So overall, the actual interest that the banks are paying on their liabilities or on the money deposited at their accounts to the tune of 433 billion, they only have to pay overall a very small amount of interest. Whereas on the asset side of their balance sheet, they're getting relatively high interest off of these people they're lending money to. And so that explains the phenomenon of net interest margin, which is, like I say, is a key part of how the bank makes money. It's the money it lends times the net interest margin. And so in this slide, you really do see quite clearly the anatomy of how a bank works and how they make money. Now, of course, what you want is for things to be a little bit stressed so that there are lots of people paying higher interest, but not to break, because if the whole system collapses and you start getting bank runs, then these assets start shrinking because it's money that they're not actually going to get back from people. That's why I'm keeping track of their stage 3 credit risk. But we see that actually throughout their lending, the stage 3 credit risk has stayed very stable in 2024 compared with the previous year. I can also look at the amount of their loans that are over 30 days payment date. Here we get a nice actual picture of the composition of their loan book. As you can see, it's mostly mortgages. And actually, we see that in 2024, it was all very stable. In fact, the credit quality improved for their retail loans. As of the first quarter 2025, the amount of their credit card loans, which were over 30-day payment date, increased from 2% to 3%, and their personal loans increased by 1%. But as we see, those are a tiny fraction of their overall lending, and these numbers are by no way alarming. They're actually quite good because it kind of indicates that a lot more people are over their overdraft limit, paying higher interest, relying on credit cards more for their holidays, and again paying more interest, but without the numbers being high enough to indicate some kind of banking crisis. So generally, looking at the quality of their credit, it looks very good still. And so when I look at the credit risk by different kinds of credit, we see that it's still fairly stable. In fact, if anything, it's becoming slightly less risky. So going back to the different business segments of retail, commercial, and private. For retail, the black line here is their overall net income from this business segment, and we see that in 2024 it did dip down overall. Like I said, the retail and private are kind of struggling a bit. It was the commercial where they're making their money. But actually, although the data did go down in 2024 year end, as of the first quarter of 2025, we see that actually the ratio totting up, including net interest margin increasing. So this actually, for me, explains why NatWest have been doing so well in the first half of 2025, because they are actually achieving improved net interest margin for retail, and actually the same for private. And here for commercial, again, we see them improving their net interest margin in the first quarter of 2025. Their different business segments are actually improving in terms of their profitability, and that explains the stock market reaction here. You can see that unlike retail and private, for commercial, for 3 years now, this has been like a boom time. This particular business segment's been performing very well, and we only see that trend continuing. So in my December video, I obviously went into detail a lot of the prehistory of the bank and more recent history. Since that video, there's not been that much news flow, and generally when there's less news flow, I look at that as a positive thing because it suggests that the management are just quiet and making money rather than having to stage new kind of news items to try and convince shareholders that they can increase the share price. And so, yeah, there's no news since my last video update, apart from having bought all the rest of the government shares. In terms of equity valuation, that's this graphic I do for all stocks, and for the banks I include the size of the loan book and the number of their loan and the amount of their loan book that's distressed as stage 2 plus 3 or just stage 3. And we see that compared with the pre-banking crisis day, when we used to have high 10-year yields, and when we look at this, we see that when we look at the market cap back in the glory days compared with now, but then also take into account the size of the loan book and the proportion of that which is bad loans, they certainly do. The market cap certainly does look really favourable now. When you look at, just say the net assets look, banks used to be valued at a multiple of their net assets and as a particular proportion of their overall loan book. Well, currently, banks don't seem to be being valued as they were back then. And so this, to me, is like an argument to banks requiring a bit of a repricing here, having been out of fashion for so long during the zero interest rate era. I started to attempt a cash flow based valuation and then found that it was impossible because we were working with negative numbers. And then actually, when I spoke to Grok and started investigating it, I found that actually discounted cash flow analysis of isn't really done for banks the same as it is done for normal stocks. The reason being what a gargoyle their accounts are and how they're kind of accounted for in this abstract way, completely different to any other kind of stock. So actually, even the experts don't really do that. What I have done crudely is look at their net income over the next 10 years and applied a 8% discount rate to that, and have found that actually the expected income, and first of all, in terms of their profit and loss statement, it's all fairly clean actually. With relatively small things like depreciation and amortization. And what we find is over a 10-year period, the amount of income we expect actually exceeds their current market cap. But that's as far as I went with that one. Looking at the shareholders, and obviously, whereas as recently as 2021, the stock was 56% owned by Her Majesty's Treasury. The situation now is one where we've got no more government holdings and actually a veritable rogues gallery of all the usual suspects in terms of major financial institutions now have got chunky ownership. So their shareholding overall is looking kind of fairly healthy now. In terms of my valuation for this stock overall, I've kind of already discussed that when I was talking about the banking sector. We've got this change from the pre-credit crisis days where we went to a zero interest rate period, which was horrible for the banks. But now that we're going back into high interest rate period, we're seeing this response in the banking sector chart. And NatWest are definitely following this trend, are in this channel. I discussed how compelling this particular graphic I did on that same theme, even if you account for stock dilution. So I've been tracking these KPI. The money a bank makes is down to the simple equation of how much money they're lending times their net interest margin. The bond yields are normalizing. They look like they're going to be lower on the short end and higher on the long end. So this should mean an increased net interest margin for banks. House prices are looking good as ever. They don't look like they're going to crash. The economy is kind of stagnating a bit, exactly as we were kind of expecting. A year ago when I put this together, I was looking for a kind of stagnant this year. And then as things start to move into growth the following year, that will only lead to more money lending. The net interest margin just staying high and the loan book staying high. So overall, everything's checking out for NatWest Group. It's looking great. I actually did get shaken out of half of my NatWest position when we had the Trump tariff dump back at the end of March this year. However, on seeing the dust settle, it's a bit like the forces of economic nationalism, which I discussed in some of my other videos, have flinched. And then, as confirmed with Rachel Reeves' latest spending review, we're catching that over here in the UK as well. We saw what happened with Elon Musk's departure from the state apparatus as he failed to stop the money printer. We're just seeing massive government money spending, and the tariff thing will be affecting the US only, but they're obviously diluting what they're doing there. And then for the UK and the rest of Europe, is going to be back to the full-on globalization game. So as long as the system doesn't break, it's just looking great for the key parameters I'm checking with NatWest, particularly the net interest margin and the loan book, and of course the yield curve, which is behaving beautifully for us. So I've actually bought back the shares in NatWest which I sold during the Trump dump, and NatWest are 10% of my portfolio now. I'm happy with what I'm seeing at this point in time. So that concludes my video. Hope you found it useful, and good luck with your own investments. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.